Everyone tells you to invest. Nobody tells you what actually happens when you do. The first 6 months of investing are weird. You'll see your money go up, then down, then sideways, and you'll question every decision. This video walks through exactly what to expect, what to do each month, and what to ignore so you don't panic sell at the worst possible time. Open 2 accounts, a Roth IRA and a taxable brokerage account. Use Fidelity, Vanguard, or Schwab. All 3 have 0 fees, 0 minimums, and index funds with expense ratios under 0.10%. In the Roth IRA, buy VTI, Vanguard Total Stock Market, or VOO, S&P 500. This is your retirement money. It grows tax-free and you can't touch it until 59.5 without penalties. Contribute what you can. The 2026 limit is $7,000 if you're under 50. In the taxable account, buy the same thing. This is your medium-term money, accessible anytime, but you pay taxes on gains when you sell. Start with whatever amount doesn't scare you: $50, $100, $500. The amount matters less than the habit. Set up automatic contributions on payday so you don't have to think about it. Your first purchase will feel anticlimactic. You'll buy shares and nothing will happen. That's normal. The magic takes years, not days. Your portfolio will drop. Maybe 2%, maybe 5%, maybe more. This is the moment most beginners panic and sell. Don't. The stock market drops 10% about once a year, 20% every 4-5 years, and 30% plus every decade. These aren't accidents, they're features. Volatility is the price of admission for 7 to 10% average annual returns. If you invested $10,000 in VOO in January 2020, by March 2020, you were down 34%. By December 2020, you were up 18%. The people who sold in March lost forever. The people who held gained. When your portfolio drops, do nothing. Don't check it. Don't read financial news. Your automatic contribution will buy more shares at lower prices. This is called dollar cost averaging, and it's the most powerful habit in investing. By month 3, you should understand what you actually bought. VTI holds about 4,000 US companies. VOO holds the 500 largest. Both are broad, diversified, and essentially bet on the entire US economy. This matters because when the news says the market is crashing, you need to know what that means for you. A 500 company index fund doesn't go to zero unless 500 major US corporations simultaneously go bankrupt. That's never happened. The worst single-year drop for the S&P 500 was 2008 at -37%, and it recovered fully within 4 years. Read one book, The Simple Path to Wealth by J.L. Collins. It explains why index funds work, why you don't need to pick individual stocks, and why the simplest strategy beats most professional investors. If you read nothing else about investing, read this. Month 4 is when investing gets boring. The novelty wore off. Your portfolio is doing nothing exciting. You're contributing automatically and checking less frequently. This is exactly where you should be. Boring is the goal. Boring means you're not reacting to news. Boring means you're not trading. Boring means your money is compounding quietly in the background while you live your life. The biggest danger now is the urge to do something. You'll see someone on TikTok who made 300% on a single stock. You'll hear about crypto or options or some new opportunity. Resist. The people making 300% on one trade are the same people who lost 90% on the next one. Index funds win by being boring and consistent. If you really need to scratch the itch, allocate 5% of your portfolio to individual stock picks. Keep 95% in index funds. If the 5% does well, great. If it doesn't, it can't hurt you. You've survived the first dip, the boring middle, and the urge to trade. Now it's time to level up. Review your budget. Can you increase your contribution by $50 a month, $100? Do it. Every increase compounds for decades. An extra $100 a month at 7% returns becomes $122,000 over 30 years. That's not a typo. $36,000 in contributions becomes $122,000 in wealth. If you get a bonus, tax refund, or any unexpected money, put at least 50% of it into your investment account. You weren't counting on it anyway. Future you will be grateful. Also, check your account less. Studies show that investors who check their portfolios daily earn lower returns than those who check monthly. The more you look, the more likely you are to react emotionally. Set a monthly check-in, look at your total balance, and close the app. After 6 months, Review your progress. You should have a Roth IRA with 3/6 contributions, a taxable account with regular contributions, an emergency fund of at least $500 to $1,000, separate from investments, no individual stock losses that stress you out, a habit of automatic investing that you don't think about your total return might be positive or negative. It doesn't matter. 6 months is noise. What matters is that the system is running. You're investing automatically, consistently, and without emotion. The next 6 months are the same, and the 6 after that, and the decades after that. Investing isn't a sprint or a marathon, it's a conveyor belt. You set it up, you keep feeding it, and it carries you toward financial independence while you sleep. The first 6 months are the hardest because everything is new and the numbers are small. Push through. The same $200 a month that feels pointless now will feel inevitable in 10 years. Start today, stay boring, and let time do the heavy lifting. Subscribe for weekly finance breakdowns. No fluff, just things that work.